The stock market is rallying again. Headlines are booming with optimism. Bulls are calling for new highs, and retail investors are piling back in. But beneath the surface, something feels off. The Federal Reserve may not come to the rescue this time. And if that's true, this entire rally could be on dangerously thin ice. For over a decade, investors have learned a simple lesson. When markets fall, the Fed intervenes. Rate cuts, stimulus injections, liquidity support, it became the norm. Every dip was a buying opportunity because the Fed always had Wall Street's back. But today's macro environment has changed. Inflation is no longer transitory. Treasury yields remain elevated, and the central bank is signaling caution, not accommodation. So why is the market rallying so confidently? Let's start with interest rates. The Fed has kept the federal funds rate steady between 4.25 and 4.5% since January 2025. That's a long pause by historical standards. But unlike previous cycles, there's no indication of an imminent pivot. In fact, the Fed has reiterated its commitment to a higher-for-longer policy. The latest dot plot showed most officials expected most one rate cut this year, and only if inflation slows further. Meanwhile, inflation hasn't cooled as much as markets hoped. The core consumer price index, which excludes food and energy, is still running at 2.8% year-over-year as of May. It's below last year's peak, but still above the Fed's 2% target. The path to victory over inflation remains uncertain, and until that path is clear, the Fed has no reason to cut. Now zoom in on the labor market. Unemployment ticked up slightly to 4.2%, but job creation remains solid. Wages are still rising in many sectors, especially in services and healthcare. From the Fed's perspective, the economy hasn't weakened enough to justify easing. If anything, they fear reigniting inflation by acting too soon, and that fear is real. Liquidity conditions tell a similar story. During previous downturns, the Fed responded with massive balance sheet expansions, trillions in quantitative easing. Today, it's the opposite. The Fed is still unwinding its holdings, though at a slower pace. In June, it continued to let $5 billion in treasuries and $35 billion in mortgage-backed securities roll off its books monthly. That's less aggressive than in 2023, but it's still tightening. The punch bowl isn't being refilled. It's being drained slowly and quietly. So why are equities rallying? Some point to the AI boom and corporate earnings holding up better than expected. Others say investors are front-running a pivot that hasn't happened. But much of the rally is driven by a narrow group of mega-cap tech stocks. The top 7 companies now make up over 30% of the S&P 500's total market capitalization, the highest since the dot-com bubble. That level of concentration increases risk. If even a few of those giants stumble, the entire index could follow. Investor sentiment is another red flag. The AAI Sentiment Survey recently showed a surge in bullish expectations, the highest since late 2021. Back then, markets corrected shortly after. Euphoria often precedes downturns, not recoveries. Yet today's retail and institutional sentiment seems convinced that a soft landing is inevitable and that rate cuts are just around the corner. But here's a contradiction. Bond markets are pricing in 2 to 3 cuts before the end of the year. Equity markets are celebrating that prospect, but they're ignoring why the Fed will cut. Not because growth is strong, but because something is breaking. Rate cuts typically signal trouble, not triumph. If the Fed is forced to cut, it may be reacting to a credit event, a recession signal, or a sudden market dislocation. That's not bullish. That's a flashing red light. And then there's the debt problem. As of June, the U.S. government has paid over $579 billion in interest on its debt in the first 7 months of fiscal 2025. That puts it on track to exceed $950 billion by year-end, surpassing the defense budget for the first time in history. This is a massive burden. Rising interest costs limit fiscal flexibility and they complicate monetary policy. If rates stay high, interest payments balloon. If the Fed cuts too soon, inflation returns. It's a lose-lose trap. Wall Street strategists are split. Some maintain their bullish outlook, citing resilient GDP data and corporate profit margins. Others are warning of a correction, arguing that valuations are stretched and fundamentals don't support current prices. But the elephant in the room isn't about earnings. It's about trust. Trust that the Fed will always catch the market. Trust that may no longer be warranted. The Fed has repeatedly emphasized that it is data-dependent, not market-dependent. and that distinction is critical. In prior years, equity declines would trigger a policy response. But in today's environment, market losses alone may not be enough. If the data, inflation, jobs, spending don't deteriorate meaningfully, the Fed will stay the course. Meanwhile, global financial conditions are tightening organically. Foreign buyers like China and Japan are scaling back purchases of U.S. Treasuries. That lowers demand and puts upward pressure on yields regardless of what the Fed does. At the same time, regional banks are still under stress from exposure to commercial real estate and underwater bond portfolios. These slow-moving risks are building beneath the surface. There are also fewer safety nets than people realize. Fiscal policy is gridlocked. No new stimulus packages are on the horizon. Corporate buybacks, which provided a major tailwind over the past decade, are slowing down due to higher borrowing costs. The market is on its own now, and the conditions that powered the last bull market are no longer in place. So what happens next? The rally could continue. Momentum can carry markets further than logic suggests. But the foundation is fragile. One geopolitical shock, one credit surprise, one earnings miss from a major tech company could flip the script. And when sentiment turns, it often turns fast. Smart money is already hedging. Demand for put options is rising. Flows into volatility ETFs are quietly increasing. Gold and Bitcoin are being accumulated not as speculation, but as protection. These are not the behaviors of euphoric bulls. These are the moves of cautious capital. The bigger question isn't whether the Fed will intervene again. It's whether they even can, or whether they want to. If inflation remains sticky and debt service costs keep rising, the Fed's ability to rescue markets becomes increasingly constrained. And if they do nothing in the face of a downturn, it will be the first real test of this market strength, unaided by stimulus. This moment is about more than just stocks. It's about a broader transition, from a world of easy money and constant bailouts to one of fiscal discipline, structural risk, and higher costs of capital. Many investors have never experienced that shift before, but it's here, and it demands a different mindset. The illusion of unlimited liquidity is breaking. The expectation of Fed omnipotence is fading, and the markets, for all their optimism, are misreading the signals. So what should you do? Start by watching what the Fed does, not what the headlines say. Track inflation. Monitor wage growth. Pay attention to bond market signals and credit spreads. Don't get distracted by daily green candles. Focus on the macro. Because this time the Fed may not step in. The market may not be saved. And if you're not prepared for that scenario, you'll be one of the millions caught off guard again. This rally may still have legs, but it's skating on thin ice. One crack and everything underneath could give way. If you want to stay ahead of the next market turn, not just react after it happens, now's the time to lock in. Subscribe to Wealth Signal and follow every shift that matters before the rest of the world catches on.